Economists often refer to a concept called aggregate demand, with an implied of goods and services often not attached to it. Now, aggregate demand is really critical to understanding how one measures economic activity in the United States, and also how we might measure changes in economic activity over time. So when we say aggregate, that means the whole, that's every member of a society. So this is the total demand. This is what people want to buy. So the aggregate demand of goods, that's products, physical products, automobiles, clothing, food, whatever. And also we take into account the aggregate demand for services. That could be going to a barbershop, getting your taxes done, going to a university. These are services, not provision of a product, but instead a service. So when we talk about aggregate demand for goods and services, we will typically divide these up into three components. Now I'm going to add over here that this version is for a closed economy. Now this is basically how we would measure it if we didn't have to worry about exports and imports. Okay, that's part of a different set of international courses. So let me set that aside for now. So now what we're talking about is the aggregate demand for domestically produced goods and services, which is going to be supplied by domestic producers of goods and services. So again, we have these three components. What do we mean by consumers? Okay, that is basically every private individual that is purchasing goods and services for private individuals actually write that again. Okay, these are purchases of goods and services for current consumption by private individuals or companies. So let's unpack that a little bit. So it's purchase of goods and services, fine, for current consumption. This is buying clothing for an individual family. It might mean the purchase of steel for an automobile company. It's going to be used to produce cars today. It might mean going down to get a haircut today. These are good purchase of goods and services, again, by private individuals and companies for use now. Now, and there are different definitions of what current might be, whether it's 6 months or 2 years or whatever. Let's not worry about that at the moment. But it's basically buying stuff, goods and services, to use today by private individuals and companies. investment, the term used investment can be confusing to students because a lot of times when you think about investment, you think about, well, I'm going to invest in the stock market. That's not what we're talking about here. This is basically purchases by private individuals and I'm going to call these private agents. Again, that's kind of an economics term. Agents, we're talking about just firms and individuals, firms and companies. Purchased by private agents for goods and services that are long lasting. Well, that's kind of a general term. So let me talk about what we might mean by that. Purchase of a house. Okay, you're buying a good. It's a physical thing, but you don't use a house. The house doesn't go away in 2 years. It stays. If you build a factory, that's an investment. It is things of long lasting value. It's not for current consumption. Now, we also have, in addition to that, if someone were to buy a product and keep it in an inventory, okay, you stock your shop, you don't sell it immediately, that would go into investment. Now that's really just a choice, a definition of how one defines investment, but inventories go into the investment part of that relationship. The government, this is purchases of goods and services by government at all levels. Okay, when we start talking about aggregate demand, and we look at the government purchases, that's at the federal level, that's at the state level, that's at the local level. It's everything. Now you can divide that up into those parts, but if you're looking at the overall aggregate demand, the total demand for goods and services, this government component will include all of those purchases. Now, one thing this does not include is so-called transfer payments. If the government uses payroll taxes, okay, so this is the money that's taken out of an individual's wages at the end of the week. It's not part of income taxes, but instead it's for Social Security, unemployment insurance, or whatever, and takes that and then transfers it to someone else. Or if it's part of the overall income tax and that money is taken and just given to somebody else, that transfer is not a purchase of a good and service. Now, it may be spent on a good and service down the road by an individual consumer, but transfers are not included in the government component here. Now, here's all this stuff. Here are these just various categories of purchases by consumers, purchases on long-lasting items, and government purchases, not transfers. What you'll often see is this summarized with the following equation. Because economists love their equations. We'll say that aggregate demand is equal to C plus I plus G. Now, sometimes people will say, oh, well, that's final consumers, business, and government. And that's kind of the right flavor of this. But if a business buys something that is going to be used immediately, that's part of consumption. An individual consumer buying a house is part of investment. And then the government is, as we described it. So that's, thinking of this as final consumers and this is businesses is okay, but it's not really right. And you'll see this equation in a number of different things that we'll be talking about, where we split the demand for the economy as a whole into consumption, investment, government spending. Now, when we add in an open economy, which you will do in other courses, we add a further source of demand into this equation. In particular, we add in exports. Okay, the total demand for goods and services, for domestically produced goods, also includes what we send to foreigners. Okay, exports. Foreigners buy our goods and services. That would be added to this in an open economy. And then we subtract imports. So why do we subtract imports of goods and services? Because when we're talking about these sets of relationships, we don't distinguish between purchases. When you collect the statistics, you don't collect how much of how many domestic automobiles that somebody buys versus how many foreign automobiles they buy. So we just lump it all into the C plus I plus G, and then subtract imports at the end. That doesn't mean that imports are bad. You subtract. It's that you want to only include the aggregate demand for domestically produced goods and services in this equation. So the C plus I plus G plus X minus M, you'll see it in most economics textbooks, and really a critical way to separate into different categories the types of purchases on goods and services. So that, for example, when we talk about changing the level of government spending, if we were talking about a fiscal policy, okay, that's something that you'll talk about later, a fiscal policy, government spending, an increase in government spending on goods and services increases aggregate demand. If there's a tax cut for consumers, income taxes drop, we're going to see that can increase the level of consumption because people have more money, more income to spend, and that can increase income. If you change the tax treatment on investment, that can change aggregate investment and aggregate demand. So when we start to talk about macroeconomic policies, this is going to be a key set of relationships. So it's important to understand this. C plus I plus G plus X minus M gives you a sense of how economic activity can be divided up, aggregate demand activity can be divided up usefully into separate categories.